Good afternoon, Impulse Traders. It's 4 p.m. Central Standard Time, well actually 5 minutes till, on June 17th. This is your week-ending market recap as well as our daily ending strategy update for ImpulseTraders.com. I have up the chart of the dollar index. So again, we've been watching this consolidative pattern between the 90 and the 70 range play out basically for 3 years now. The consolidation, it broke to the downside, and this recent rally in the dollar has yet to break back above the lower trend line of that triangle consolidation. Kind of just jumping in here, but going back to some, of the dollar, so going back to some of the previous work we've done with the dollar, we noted when this trend line broke, it was tested twice after it broke, and both times it failed to break back above it. I kind of see this rally right now as potentially just a test of that broken support now as resistance. For the dollar, we still have yet to break back above the 100-day moving average, and are still well below the 200-day moving average. We've been flirting with the 55-day moving average, and that 55-day moving average, most of the time on the way down and up, acts as some kind of good swing indicator. When we're below it, you're bullish or bearish, and when you're above it, you're bullish. But as it stands now, I think we need to maybe step back to a weekly chart here, because the intraday stuff, and we'll take a look at that in a minute. At least for the dollar and the euro, it seems like a very choppy market. So in my opinion, we're kind of between two big levels. I think we're fairly range bound, and we will remain that way for at least the remainder of likely the summer until liquidity returns in August. So on the weekly time frame, the dollar has been trading lower in a series of extensions from its 103 lows. The precise low was 103.54 on the Dixie. That's the $ DXY. That's the US dollar futures cash composite. We traded these extensions once to target. So that's once to target. Same anchor, new low. Front run, but went to target. Bounced off our target. Same anchor, new low. 3 times. Apologize for this. 3 times. Let's move it over a little bit. All the way down to target. And same anchor, new low. Traded once more back up the 87 figure. Never broke and invalidated this trend, which maintains a downside target for the Dixie at 63.50s or 63.46. We'll just say 63.50 to be safe. Those downside targets seem to be confirmed now by some daily targets. So that 63.50 downside target would correlate, probably be my simplest guess, would correlate with that larger target at the 78 figure for the euro dollar, which I just pulled up now here. So that would be some kind of major panic low for the dollar that I think would get reversed, and it would be a multi-decade move that would get reversed. Okay, back to the Dixie. Weekly. Let's bring up our daily. So now that we know we're technically in a short setup targeting new lows for the dollar, having broken out of this daily consolidation pattern over the last 3 years, we're now coming back up to test it as resistance. And I see the potential for the dollar to basically possibly rally a little bit here, but I don't see us overtaking the 200-day moving average, which would likely correlate with the test of this trend line at like this, just below the 78 figure. Let's actually call it the 77 figure evens. Now we are also technically holding this downward sloping trend line, which is drawn, from our 2010 highs to really our 2011 highs. We are still holding that downward sloping trend line, which is this dotted line. And the series of extensions that have taken us down in this move that traded once to target, twice to target, pulling the same anchor new low, we have a technical invalidation for this series of extensions to new lows at the 80-30 figure. As long as we technically remain below there, we do target new lows, specifically at the 70 figure, which aligns perfectly with a probable triangle target, which is a 100% extension of the triangle's average range, which would bring us to new all-time lows. So with that being said, there's an overwhelmingly high probability with all of these things correlating that we potentially go to a new low in the dollar. If we do rally from here, we have looked at the corrective nature of this pattern. This is 3 equal legs down, so there is the potential that we could rally up in some kind of big A, B, C wave flat. But even then, we'd have to break above the 91 figure to truly sustain any decade, a multi-year rally, to sustain any multi-year rally. And that would, I really just don't see that happening right now. At least not with the current fundamentals at play and the current technicals in the charts, what the tape is reading. Now I want to move down to a 180-day 4-hour chart. Let me get rid of some of these lines on it. Wonderful. Okay. So, in the series of measured moves that brought us down from the 81 figure, we started off, holding extensions. Traded once to target, blew through targets, and we failed extensions. That means we're either going to hold same anchor new low here, which comes in at just about the 77 figure. Hint, hint. If we do rally, that's a probable place to be selling the dollar again. Right in this area, anywhere from 76 to 77 seems like a good place to offer the dollar. I do believe, however, longs failed to hold a long level for the dollar longs, and we'll show this on the euro dollar. But we also technically failed some short setups inside of this measured move for the dollar. So with that being said, looking to be that there's some high probability that we're going into some kind of consolidation or range-bound market between basically 2011 lows and potentially, the what is this, 77 figure. So I'm looking for the dollar to kind of go range bound now between 72 and 77. It's a pretty big range. It's that's a pretty substantial move. In the euro dollar, it's going to result in a 500 so pip range, and that was just a ballpark guess right now. We'll take a look at that range in a moment, but I don't see any catalyst for a major reversal in the dollar, and consolidating on lows, really consolidating very close to all-time lows for the dollar, does suggest some kind of continuation pattern. And that's for the dollar, that would be the healthiest thing in the world for it to happen. Is actually a rally from here would not be very healthy. A rally from here would likely mean some kind of longer term reversal back down to new all-time lows before we really reverse and go higher in the dollar. But as it stands right now, the dollar, the best thing in the world could happen is have that big panic low in the dollar, and then the swift reversal from the, really the areas I'm watching are that 70 figure, where there seems to be a lot of there seems to be a an area of interest in the market, and then of course this 63 figure, which is the longer weekly term target, which would be the 178 target for the euro. Those would be, I think, major areas that the dollar could be potentially bought in huge quantities at for a multi-decade swing trade. So the euro dollar. So from a daily standpoint, we've been taking a look. I'm going to bring up my fib tool here, taking a look at this chart in order to kind of determine where we are in this trend. And the trend was pretty clear before. We had from the all-time lows to all-time highs for the euro dollar, which is basically the 80 cent to $1.60 range. We held it all the way halfway back at the 120 figure, and that was in 2010. Those 2010 lows. The dollar then reversed, and since then we've been heading higher in a series